Hey, everybody. We have a pretty big question. What's the next catalyst for global equities and what segments will lead? We'll attempt to answer some of this and give you our thoughts. And I think just starting at the high level in equities, I have a lot on this page. Certainly a lot to cover from the first half of this year. Interestingly, if you went to sleep on January 1st and you woke up today, you saw the S&P up 4%, you'd say, yeah, it looks like it's been a relatively smooth year, but it has been anything but in equities. We've seen historic levels of uncertainty, volatility, one of the fastest drawdowns earlier in the first half, and then followed by one of the fastest recoveries, and we're kind of knocking on the doors of all-time highs once again. So I think one of the big takeaways from the first half of the year was that the great expectations that we talked about definitely did reset in a number of areas. If you looked at positioning entering the year and sentiment, they were both very crowded and elevated and highly bullish. A lot of those have reset, and they're actually below average levels, which is, in our view, a tailwind to equities in the coming quarters. Yeah, I'd say fundamentals have actually improved as well. Earnings for Q1 were much better than expected. That's certainly a healthy sign, especially given that the valuations on the broader S&P 500 are pretty lofty levels. But I think, our view for the back half of this year is consistent with what we said in the first half. It's expect greater volatility. We expect a wide, choppy range in equities. That has certainly played out. We do think that there is this potential for a continued melt up in equities, get into some of the rationale there. But I think in this environment of elevated volatility and choppiness, it remains prudent for investors to be disciplined around valuation, not taking on, excessive risks. It's not a great environment for that type of risk taking. We want to prioritize diversification and really benefit from the ability of global equity markets to provide risk management to portfolios, as we've seen international markets do so far this year. And then I think prioritizing fundamentals is going to be critical in an environment with stretched valuations and a tough environment for corporate profitability. The companies that can deliver on earnings expectations are likely to continue to be rewarded, as we've seen. So we show this chart every quarter. It's a look at sort of our scenario analysis of what multiple is currently on the S&P 500. What's the earnings growth projection for 2025? We're currently sitting at about $263 per share, trading at 22 and a half times earnings. So the market is sort of right in the middle of this green circle, but we just added this extra circle in the lighter green to show that there are a wide range of outcomes. The multiple can certainly drift higher here, and we'll get into why. And then we think there's potential for earnings to either come in a little bit better than expected, or if we do see great increased trade uncertainty and more restrictive policy, it's potential that earnings growth does not materialize and meet those expectations. So just important to remember that the market is typically volatile, but this is probably going to be one of our more volatile years, as we've already seen. On the next page, we want to show the valuation of the S&P 500. So as you can see today, we're getting back up to those levels we last saw in 2021, sort of 22 times forward earnings. It's a market that's probably 15% above its 10-year average valuation. So not wildly expensive. And in some ways, you can argue that valuation today is justified based on profitability metrics in a lot of companies. But I think for these multiples to stay at these levels or even push higher, which is certainly possible, we're going to need to see operating margins and gross margins at the average company continue to hold up and probably reach record levels, which we'll get into on the next page. When we look at why the S&P has carried this higher multiple and why it could go higher, it's a lot of the index heavyweights that account for over 30% of the index. They have great profitability. Most of the Mag 7 names generate a lot of free cash flow. They've thus far produced a lot of impressive returns on invested capital. And so that composition is certainly a driving factor behind the current multiples. But I think if you just look at the chart on the right here and the top 3,000 companies in the US market, today almost 40% of them have gross margins above 60%. If you go back to sort of the mid 2000s, less than 25% of companies had that level of profitability. So we've definitely seen increased profitability across the market. And that's really why we've been able to push higher on the valuation side. But as we said, for those valuations to stay at these levels or expand, we're going to need to continue to see this level of profitability. We wanted to just quickly touch on positioning. We said at the beginning of the year it had gotten very extended on the bullish side. Back in March and April, kind of at the market lows, the positioning for institutional investors had reached about as negative as it gets. And thus far, it has recovered a little bit. But as Cameron said, institutional investors have really sat out a good portion of this recovery since the April lows. They remain generally underweight equities, and that rebuilding of long positioning is a potential tailwind to equities as those investors come back into the market. We can call it a pain trade or a melt up, but as the market continues to grind higher, more and more of these institutional investors are resetting their positioning and getting back that average level. Just looking at the earnings growth forecast for the coming year, we do have an expectation of record operating margins on the S&P 500. We've never seen 17% operating margins, but we're going to get to $263 of earnings per share, that's likely going to have to come from operating margin expansion. We typically don't get that when we have measures of PPI and CPI that are relatively benign, at PPI at 1.4%. And we also don't see that when we have revenue growth of, say, 4 to 5% for the rest of this year. And we have seen companies so far really surprise on their profitability. Companies have reduced headcount and maintained revenue growth over the past couple quarters. So we will certainly need to see that continue. But I would say this is a lofty expectation and one risk to the overall EPS estimates for the S&P 500. This is an interesting consideration for equities. We have seen earnings estimates declining for the last probably since last fall for 2025 and 2026. You can see here on the right side of this chart, those expectations have now started to level off and actually tick slightly higher. This is not the best market timing tool, but it does act as a headwind or tailwind to equities. When you see analyst revisions and earnings expectations falling, typically you see the S&P follows suit, and conversely, when expectations are rising, it does tend to support a bull market. So we're closely watching these measures, and if they potentially bottom, that's another reason to be optimistic around the path for equities going forward. Where there has been divergence in the expectations is really between the large growth segment and the large value segment. The large growth segment, a lot of which is made up of the Magnificent Seven stocks, is actually holding up very well. They posted a very strong first quarter of earnings growth. If you look at the value segment, those expectations continue to get cut. And this is one reason why we think market breadth and we might see greater concentration in the market going forward, is because as those earnings expectations continue to gravitate around the growthier names, it just presents a bit of a challenge to the sort of broadening out of market performance. On the next page, we have a look at this sort of main question. What's going to lead going forward? Will it be those secular AI type growers, or will we see a cyclical recovery or a broadening trade? On the left side of the page, you can see we have the earnings expectations for the coming quarters for both the Mag 7 and the other 493. So those expectations are going to start to normalize. The Magnificent 7 has produced phenomenal earnings growth over the past couple of quarters. As they've gotten bigger and they're up against tough comparisons on a year-over-year basis, those growth numbers are going to start to come down. And we do expect to see greater participation and earnings growth from the other 493 names. So you can see by Q1 of next year, both segments are probably on pace to produce about 10% earnings growth. So I think from a fundamental standpoint, that does tell you that there is a case to be made for broadening probably later this year. But on the chart on the right, I think what we looked at here is the equity market performance and the Fed path of the Fed funds rate. So this is looking at 2026 Fed funds futures, and as you can see, the Magnificent Seven in the sort of navy blue or blue line has actually correlated pretty well with the Fed funds futures rate. So when people are expecting a more dovish Fed or lower Fed funds futures, we have seen better breadth in the market, but better participation from the average stock and small cap stocks. But as those Fed funds futures have drifted higher here in the last couple of months, you've seen once again the Magnificent Seven sort of lead the market higher. So this is something to closely watch. I think if you do get healthy earnings growth that comes in as expected from the other 493, and we get a more accommodative Fed or a little bit of a lower, greater chance of cuts in the coming quarters, maybe we do see better breadth. But I think at this point we would say that's a wait and see item, and we want to probably prioritize companies that are less dependent on that Fed funds rate for performance. International markets have been an incredible bright spot this year. The performance has vastly exceeded that of the US markets, both from developed and emerging market economies. What we saw is the dollar has been a factor in this performance, but it's not the entire story. There has been a substantial increase in 2025 and 2026 earnings estimates. I believe policy uncertainty is a little bit less so in foreign markets. The environment for consumers has been a little bit more supportive for consumption. And we're seeing that come in flow into their earnings expectations and the earnings growth. So we still think international markets are attractive valuations relative to the US. They've served as a great diversifier in portfolios. I think that can continue to be the case. I think the path for the US dollar is generally going to continue to be weaker, but I think we'll see bumps along the way. Putting all that together, it just tells you it's a good time to just make sure you're not too far underweight international equities. And on our last page, I just wanted to wrap up with a quick recap of the quality factor and why we continue to prioritize this factor in our equity strategies and just as a firm. Quality is a type of attribute that is really built to withstand volatile periods and periods of uncertainty. You get earnings consistency without a lot of rate sensitivity. Quality as a factor performed very well in the drawdown we saw in early April. And I think given where valuations are in the broader equity markets, I think continuing to prioritize these higher quality companies that are adept at creating shareholder value and consistent earnings growth should continue to reward investors.